These are the Simplify Treasury Futures ETFs. Simplify Short-Term Treasury Futures Strategy ETF, ticker symbol TUA, and Simplify Intermediate Term Treasury Futures Strategy ETF, ticker symbol TYA. In this video, we'll discuss what are TUA and TYA, how they're managed, use cases, benefits of using TUA and TYA, and portfolio implementation. First, what exactly are TUA and TYA? These are U.S. Treasury bond ETFs. They obtain U.S. Treasury exposure via futures contracts. They target specific points on the Treasury yield curve. They also target specific duration ranges. Here are their key characteristics. TUA has about 5 times exposure to the 2-year U.S. Treasury note, giving a duration of about 8 to 9 years. It's benchmarked to the ICE U.S. Treasury 7 to 10-year index. TYA has about 3 times exposure to the 10-year U.S. Treasury note, giving it a duration of about 16 to 20 years. It's benchmarked to the ICE U.S. Treasury 20-plus year index. The most important takeaway is that TUA uses exposure to the front end of the yield curve, sized in an amount that gives it intermediate Treasury duration, while TYA uses exposure to the middle part of the yield curve, sized in an amount that it gives it long-term Treasury bond duration. These funds are managed quite simply. Both funds are systematically managed. That means that Simplify is not making any bets on the direction of interest rates. The funds contain mostly U.S. Treasury bills, plus a quantity of the most actively traded Treasury futures contracts sized to meet the target duration. Contracts are rolled quarterly as they approach expiration. This makes the funds simple, transparent, and easy for investors to model. The big question is why? There are ETFs that already exist in the marketplace that target intermediate and long duration treasuries. Why use products that match these durations by using shorter maturity treasuries? There are many potential uses which can be grouped into 3 primary categories: enhanced carry, increased capital efficiency, and to put on curve trades. Let's discuss each of the 3 use cases. The first use case for these products is enhanced carry over time. Carry is defined as the return investors would earn from a bond assuming no changes to the yield curve. Historically, the shorter the maturity of the Treasury, the higher the carry per unit of risk. There are several underlying factors involved, with the primary one being increased coupons. Looking at average coupons over the past 45 years as shown in the gold bars versus duration as shown in the blue bars, we can see that historically, there is surprisingly little difference in coupons from 2 years to 20 years. However, there is a dramatic difference in duration. This results in shorter-term bonds having higher coupons per unit of duration. Another reason to consider TUA and TYA is capital efficiency. Let's look at an example. Suppose an investor wishes to allocate 20% of their portfolio to an alternative investment such as managed futures, but they don't wish to reduce their current allocations. The investor starts with a 70% allocation to stocks and a 30% allocation to intermediate bonds. The investor could replace their 30% position in intermediate bonds with a 10% allocation to TYA. This maintains a similar fixed income exposure while freeing up to 20% that could be used to allocate towards managed futures. The end result is that the managed futures returns are not pulled out of the stock and bond returns, they are stacked on top of them. The final category of use cases is putting on a curve trade. In this example, the investor believes that yields will decline and the yield curve will steepen. For example, the 2-year yield declines 150 basis points and the 10-year yield declines 100 basis points. What are some ways the investor can express this idea? Since the investor believes the 2-year treasuries will decline most in yield, option 1 would simply be to buy 2-year treasuries. Suppose the yield declines, as the investor predicted, about 150 basis points. The implied price gain is about 2.7%. Not a very inspiring return given the investor's successful prediction. The reason the returns were so modest is because there just isn't much duration in a 2-year treasury. So in option 2, the investor could get more duration by investing in a longer duration security, such as an ICE 7 to 10-year Treasury Index Fund. If the 10-year Treasury yield declines 100 basis points as expected, the implied price gain would be approximately 7.2%, which is an improvement. But in our example, the investor believes the 2-year yield will decline more than the 10-year. Option 3 would be to buy TUA, which invests in 2-year Treasury futures. Assuming 150 basis point decline in yields, the implied price gain would be roughly 13.4%. So in this example, given the investor's thesis on rates, TUA would be the best option to express this idea. TYA can be used similarly if investors believe the 10-year Treasury is the more favorable part of the yield curve. What are some of the benefits of using TUA and TYA? First, it is an extremely convenient form of leverage. ETFs are a much more convenient vehicle than attempting to put on the trade by investing directly in futures. The vast majority of individual investors and even financial advisors do not have access to futures. The funds are systematically managed, simple, and transparent. This makes them easy for allocators to model. Lastly, the funds are easy to trade as the underlying securities are among the world's most liquid, resulting in tight bid-ask spreads. Portfolio implementation will depend on the investor's intended use for the funds. If used as a one-for-one replacement of a traditional fund, and the goal is to maintain a similar level of duration, then TUA can be used to replace an intermediate duration fund, while TYA can be used to replace a long duration bond fund. Investors can then enjoy the benefits of higher carry over time. If the goal is to use the funds for capital efficiency purposes, then $1 in TUA can be used to replace $5 of short duration bonds, while $1 in TYA can be used to replace $3 in intermediate duration bond. Lastly, in a curve trade, there is no rule of thumb. The investor should simply size the position according to their desired exposure. Now for some Q&A. Where did the funds fall on the investment risk spectrum? TUA will have a similar duration risk as a 10-year U.S. Treasury bond, while TYA will have similar duration risk as a 20-year U.S. Treasury bond. How does an inverted yield curve affect TUA and TYA's carry? An inverted yield curve has been a headwind to both funds since inception. A return to a normal, upward-sloping yield curve shape would be a tailwind. Do the Treasury futures have counterparty risk? Treasury futures contracts are cleared and guaranteed by the Chicago Mercantile Exchange. All parties to the contract must post margin that's set by the CME at an amount that will guarantee execution. Yes, technically the counterparty risk is not zero, but for all realistic purposes, counterparty risk on U.S. Treasury futures is not something that investors need to think about. What about liquidity risk in the event of a severe crisis? Treasury futures are among the world's most liquid instruments. In fact, 2-year, 10-year, and 30-year Treasury futures all trade at higher volumes than the actual underlying Treasury bond. During times of crisis, or ultra-high volume trading days, this difference in volume gets even larger in favor of futures. What is the fund's tax treatment? Income from Treasury bills is taxed at ordinary income tax rates, but is exempt from state and local taxes. Gains from futures contracts are taxed 60% of the investor's long-term capital gains rate and 40% at the investor's short-term capital gains rate. The funds distribute monthly. Thanks for watching this presentation. To find out more about these and other Simplify ETFs, please go to simplify.us. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can get in touch with us directly and we'll respond promptly.